Good afternoon, everyone, and welcome to this Kepler Trust Intelligence webinar. The theme of the week is megatrends, and today we're turning to biotech. The sector's been under the cosh a bit in recent years, like many growth sectors, but recent indications are that the cycle might be turning. Shortly, we'll be hearing from Elsa and Marek, managers of International Biotechnology Trust. They've now been running the fund for almost exactly 3 years, and over that time frame, they've produced very strong returns, both versus the index and versus their peers. You can read more about that in our latest note, which was published on the site yesterday. Before I hand over, please remember that if you'd like to ask a question, you can do so in the box on the side of your screen, and I'll put those to the managers at the end. We have around 25 to 30 minutes reserved for the presentation, and we should have plenty of time for questions after that. So with that, I will hand over.
Thank you, Thomas, and thank you, Kepler, for inviting us on your Megatrends series. So I'll be running through the International Biotechnology Trust's presentation. If we could open up the slides. Super. So kicking off, an introduction to the team. You've got on the call today, Marek and me, who'll run through IBT. My background is I've worked on buy side looking into biotech companies since the early noughties, so over 20 years now. Worked at various different buy side houses. Marek has worked in the industry, so he's actually had he's been getting his hands dirty to helping develop drugs, and also worked a lot in biz dev departments within biotech, so really understands what pharma are looking for and the valuations that they're willing to pay. So moving to the next slide. So taking a step back, early last year, SV Health investors served notice on the trust because they wanted to focus on the venture part of their business. The board of directors spoke to the top shareholders of the trust and got feedback as to what the shareholders wanted to see. And the consensus view was to keep the mandate the same, keep the team intact, have continued venture exposure, and they then put the trust out to tender, and over 20 different houses showed interest in taking on the trust, including Schroders. Various different due diligence processes then carried out by the board, and we moved to Schroders in November of last year. The reason we moved to Schroders, as you can see from this slide, is that we slot nicely into the offering that Schroders has, in that they have larger cap healthcare pharma funds on the right-hand side, with John managing that. And then on the left-hand side, they too have a venture side of the business. And as you're aware, we slot nicely in between that with the biotech public offering. So moving on to the next slide, an overview of IBT. This is a trust that invests in the innovative part of the pharmaceutical industry. So ideas coming out of university and early startups with the venture portfolio, moving up to larger cap biotech companies. Thomas mentioned it was our 3-year anniversary Friday just gone, where Marek and I have been co-lead managers of the trust. We've been working on IBT for a combined number of 26 years on IBT. I started in 2006 and Marek in 2013. And the performance of the trust in NAV terms is that we've outperformed the benchmark, the Nasdaq Biotech Index, over 1, 3, 5, and 10 years to the end of January 2024. Volatility-wise, we've managed to historically have a lower volatility versus our benchmark. That has now changed. We've done that actively, and I'll come on to why we've done that in the presentation. We also pay a 4% dividend yield out of the trust in 2 installments, 2%, 2%. That comes out of capital. We can talk a bit about where that money comes from. We have a lot of M&A in our sector, and we've had 23 deals come out of the trust in the past since 2020. And that's given us cash inflow to pay out to the dividend. And it's backed up by the expert team that you're seeing now, Marek and me, plus the experience and know-how of the Schroders team as well. And now that we are at Schroders Unit Trust Limited, we have the support of their strong sales team and with a view to growing the trust over time. So turning to the next slide, you can see the performance I just mentioned in numbers. NAV-wise, good returns versus our benchmark over the various different time zones. And over 10 years, 193% return. The next slide, the usual disclaimers that we should show. And I'm going to hand over the presentation to Marek. He's going to talk about the fundamental sector drivers of the biotech sector, and I'm going to come back in the later part of the presentation. Marek, over to you.
Thank you, Elsa. So if you move on to the next slide, you can see this is the mega trends we are talking about. We are getting older, the world is graying, and this slide shows you that the population above the age of 65 will go up 200% in the coming 60, 70 years. And as you can see, the rest of the global population will actually not grow. So we are getting older. And why is that? Why is that important? If you turn the slide, you can see that also as we get older and as the world is also getting richer, which is a good thing for everyone, the healthcare spend actually tends to increase as countries get richer, which makes total sense. First, we want to is a survival, then you get a housing, and then health, and you can grow older, and that's a really good thing. As you can see on this slide, United States, Switzerland, Germany have the highest healthcare spend of GDP, which is around between 10 and 15% among the richest countries. What's important also to mention, which I think I will do at this stage, is that pharmaceutical spend out of healthcare is around 10%, meaning that if you have 10% GDP spend on healthcare, approximately 1% is spent on pharmaceuticals, to just keep you in some perspectives. If you change the slide, in my previous slides, you can see when we get older, we also tend to get ailments. And in this slide also shows you that as soon as we turn approximately 50, diseases like heart disease, cancer, Alzheimer's, and stroke tend to increase exponentially. And in a way, a good thing, because previously we didn't reach this age, and now we do. So we will, as you follow this, you can understand that the older we get, the sicker we get as well. And will also mean that we have a lot of demand coming from the population. If you turn the slide, the industry is also responding to the high demands from the society of new improved drugs. On the left-hand side, you can see the number of ongoing clinical trials, which basically have doubled during the last decade. And on the right-hand side, you can see number of drug approvals by the FDA, which is steadily ticking upwards. We had a interruption in 2022 when the COVID pandemic aftermaths created some backlog with the FDA, but we continuously believe that number of approvals will continue to go upwards. What's good with this industry, it's very resilient in terms of sales, irrespective of economical backdrop, inflation numbers, interest rates. Pharmaceutical spending is one of the last things politicians will touch, and is the last thing consumers or patients will stop spending on. And you can look at this slide, approximately 5% annual growth in pharmaceutical spend, and it has been very good trend over the last 20-30 years, I would say, even though this slide only shows down to 2017. What's important also to have back of your mind is that approximately it takes 10 years to develop a drug. Then a drug is on the market for approximately 10 to 15 years. Then once patent expiries come, the drug becomes almost for free to society. It's only production cost and the profit for the generic company that produces that. In this slide, it's 5% annual growth, but within that, you have an annual, approximately 5% of sales will disappear in terms of generics. So fundamentally, this industry of new drugs grows twice the speed as you see on this slide. And at IBT, we focus on the more innovative side of the industry, meaning addressing high unmet need. And rare diseases on this slide is one of these areas where we probably prefer to address the very high unmet need, often children, and some rare cancer diseases. And this part of the industry grows twice as fast as the rest of the industry. If we move on, what has happened during the last 10, 15 years in this mega trend? 20 years ago, we started to understand the genetical footprint, what we have. The genome was sequenced 20 years ago. And since then, we have started to understand the biology of everything much better. We are still in early days, and science is exponentially getting better and better. But what's interesting, during the last decade, we have seen this science come into fruition and becoming drugs. On the left-hand side, you can see cell-based therapies, which basically are patient cells taken out from the patient, modified, expanded, and put back into patients to combat cancer. And it sounds very science fiction, but there are several drugs on the market and cells in the billions at the moment. It's a very, very interesting area of science. Currently, we can address only a slither of cancer forms, but we are getting better and better at it as every iteration. Gene therapies, you insert a gene when you have a malfunctioning one or non-functioning one. There are drugs on the market that treat hemophilia and sickle cell anemia, and we are only in the first innings of these therapeutic options. RNA therapies, needless to say, the Moderna vaccine was very, very quickly developed through this technology, which offers a lot of different optionalities for diseases that previously were considered undruggable. And the latest addition to this is gene editing, when we change one part of a gene or a snippet of the gene to restore function of the gene. All four of therapeutic areas here, options, have drugs approved on the market. If we move on, since we are investors in biotech, we of course love science, but there is also a way you need to make money out of science. Otherwise, we will not be able to reinvest money into new drugs. One thing that is the correlation, which is very interesting, is the interest rates are very highly correlated with biotech stock prices. One reason which we think is very relevant is that it takes approximately 10 years to develop a drug, and the 10-year interest yield in the US is very highly correlated. So in a way, it's cost of money, what we are talking about. And you can see on this graph, as soon as interest rates move up, biotech sector, this is the dark green graph, represents the smaller biotech names. You can see that they are highly affected, and once interest rates come down, biotech tends to perform relatively better. This is why recessions often has proven that biotech tends to do quite okay during recessions on a relative basis, because they often are affected going into recessions. If you move on, since we are in a megatrend session here, you can see that biotech over time tends to outperform the world healthcare. So meaning saying that biotech usually tends to do better than pharma, that do better than healthcare in general. And this slide shows you it's more volatile. That's the industry, how it operates. But over time have outperformed the rest of the healthcare indices. And you can see on this slide 450% over the last 20 years. If we move on, this is a slide showing the last 5 years. We wanted to catch the pandemic period and how biotech has fared during that period. And as you can see, the light green is the XBI index, which represents equal weighted, in essence, the smaller names, whereas dark green is more market cap weighted biotech, less volatile, and the blue one is S&P 500. What's interesting to see is that once the pandemic hit, everything went down by approximately 30%. But when interest rates came down and we had a lot of monetary stimulus coming through to the equities market, the high risk endeavors, meaning the small names, went up dramatically, around 200% in just months. Me and Asa took over almost at the peak, and we had to take a very tough decisions as fund managers. We decided this market is overcooked, valuations are way too high, and we need to do something about it. So we moved into the larger names, the more stable companies that generate a lot of cash, the Gilead, the Amgens, P valuations relatively low, but stable companies. And as you see, the market corrected very quickly after that when interest rates started to be coming through. And also over time, you can see that we had another leg down when inflation continued up and was not under control. But since approximately mid last year or end of 2022, it has been stable, and we have had a relatively good run since October when interest rates peaked. But I also want you to see during these 5 years, a lot has happened, but we are basically on the same level as it was 5 years ago. And considering this industry has a fundamentally underlying growth of approximately 5 to 10%. So I will leave it to Elsa to carry on with the sentiment of the sector.
Thank you, Marek. So leading on from Marek's point about the cyclicality of the biotech market and the various different reasons behind that, each month you can follow our blogs that we put onto the website. And one of those blogs we wrote a few years ago now, talking about the cyclicality and why biotech has various different stages. And we wanted to classify that and then give various different characteristics to those stages. And this is what we came up with. We feel that there are various different points that we've passed through since 2021 at the peak during the pandemic, or just coming out of the pandemic, and we would classify that as a sort of euphoric stage 4, when valuations feel too toppy. One example is a gene editing company that was trading at over $10 billion in market cap that hadn't even put their product into patients yet, so preclinical. That company has since managed to launch a product on the market and is trading at less than half that valuation today. So it's really interesting how the valuations can move depending on where you are in this cycle. Moving through the stages, correction is when M&A dries up, valuations are probably too high. We see outflows of investments. Despair is when we feel that the market has bottomed out. M&A hasn't yet picked up because boards and management teams need to accept the re-rating of their stocks. Stage 2 is what we call recovery. We feel that that's sort of more 2023 stage. So we saw M&A, record numbers of M&A last year as management teams accept the re-rating in their share price, but not yet equilibrium stage. And then we've moved the arrow in the middle into equilibrium for the early part of this year. And the reason behind that is because we've seen a pickup in fundraisings within the sector. The IPO window has creeped open. So we think we're in equilibrium. Hopefully this stage is a stock picking environment, stabilization of the market. Hopefully this isn't a protracted time for the sector. So moving to the next slide, I just mentioned that fundraisings have picked up. This slide shows the green bars of secondary financings. Still managed to have secondary financings in the 3-year bear market that we're experienced just recently. But the IPO, the dark blue, you can see was really very slow, but that's picked up this year too. So we think there's some real green shoots here, and we should hopefully see a recovery in the sector overall. Turning to the next slide. This is an important factor to mention. So there is a big wave of patent expiries towards the end of this decade for large selling drugs, which are mostly sold by the big pharma companies. This is a big problem for them. They've got to not only replace the sales that are coming off patent, but add on top of that in order for them to grow their top line. So how are they going to go about that? They're going to go about that by internal R&D, but that's been proving to not be as productive than historically. So what they're doing is they're acquiring in products, successful biotech companies. That peak in patent expiries is just coming ever closer, and we think it's going to be exacerbated by the new legislation that's being brought into the US to negotiate drug prices, which is putting even more pressure on these guys. So we think M&A is going to continue. Over the page, you can see the deals that we've had within IBT. I mentioned at the beginning of the presentation, since May 2020 on this slide, we've had 23 acquisitions. All of the bubbles above the x-axis are M&A deals coming out of the quoted part of the portfolio, and below the x-axis are deals coming out of the venture part of the portfolio. The left-hand side y-axis, you can see the premiums paid for these deals. They're good, hefty premiums, and it's really significantly helped our NAV returns during that time. A couple of case studies over the next slide. This one is a relatively small company. This is in our top 10. It's been a huge success for the fund in recent months. What does it do? So this is a disease-modifying drug. It's in development. It's not on the market yet. About to go into phase 3 development, so the last stage of development. It's for a disease called IgA nephropathy. There are only 2 drugs on the market right now for this disease, and one of them is a steroid, and the other one is symptom modifying. These guys have got a disease modifying drug, and the data so far has been incredible. They've shown basically that kidney function has plateaued when taking this drug, whereas normally the kidney function deteriorates markedly every year, and often these patients end up on dialysis or kidney transplant. So really exciting story, and they are, as I said, phase 3 ready. Next example, another incredibly exciting story. End of last year, Cytokinetics announced strong phase 3 data. So this is the last stage of clinical development for their drug in a specific type of heart disease. It's about 1 in 500 patients have heart disease, called hypertrophic cardiomyopathy. The next stage for these guys is to publish the data in a medical journal, for example, or a medical conference, more detailed data, and then they'll file the drug to the FDA. Okay, so portfolio analysis. How do we go about management of IBT, and what's our process? So this slide shows on the left-hand side, idea generation. Marek and I go over to the US, where the most of our investments are, and attend medical and investor conferences to meet the people who are managing the companies that we invest in. We have access to key opinion leaders. This is important. So for disease areas that we may not be as familiar with, we can pick up the phone and ask real specialists about what their view is on various drugs, for example. Risk mitigation, something else that differentiates us from other funds, is that we actively reduce our exposure to various different, what we call binary events. This is to preserve capital. When you lose money in investment, it's very difficult to get that back. So we do that. We are very valuation sensitive. I mentioned at the beginning that Marek used to work in biotech biz dev teams, so he understands how pharma values companies, and we will take profits and step aside if we think a company valuation is too high. And finally, macro considerations. So as an investment trust, we're a closed-ended fund, we can gear, and you can see that we actively manage this gearing position. When interest rates peaked at 5% in the US in October last year, we had a very large relative gearing position of just over 15% of the fund. In fact, that was one of the largest gearing positions we've ever had since the credit crunch in 08-09. That just goes to speak to how strongly we felt about the market at the time. We've since taken profits on a very sharp rebound, and we've had some consolidation since then. So we do actively manage that gearing position. It's very unlikely we'll go to a cash position. Moving over to the next slide, I've sort of already touched on this, but we do manage the fund on a bottom-up and top-down basis. So if we feel that the market's looking too heated in various different pockets of biotech, which happens, if you remember the cycle chart I showed, people do get overexcited about disease areas, valuations get forgotten and look very expensive at times. We will move to the side on those names and invest in areas where we see value. And from a bottom-up perspective, the things that we look for in a company, we like wholly owned assets, ideally. We want treatments that really treat unmet medical need. Ideally, a monopoly position, doesn't have to be, but that's the ideal situation. Financial strength. So if a company isn't making money or having revenues, then we want to see that they have enough cash to run for, say, 2 years. Strong management teams, and obviously I mentioned we are valuation sensitive. So moving to portfolio composition. If you just take a look at the top right-hand side, you can see that just under a third of the trust, so 31%, are in early stage companies. So these are companies that haven't yet launched a product, so they're in the clinic. And then 27% in revenue growth names. These are companies that have managed to get a product through the clinic successfully, through the regulator successfully. They've launched, they're making revenues, but they've not yet turned a profit. And then over 40% of the trust are in profitable biotech companies. On the top left-hand side, you can see the market cap diversification of the trust. So we're invested in companies that are in the venture side, incredibly small, all the way up to mega cap companies, some of which are over 30 billion in market cap. Bottom left, you can see that we have various different portions of the fund in disease areas. So we like rare diseases. If you remember, Marek spoke to how fast the rare disease area of the market's growing. So we have a good proportion of the trust in those names. We like cancer names. Obviously, that's still an incredibly high unmet medical need. And mental health. So CNS stands for central nervous system. We've got a good chunk of the fund in names addressing those diseases as well. As I've mentioned, just under 90% of the fund is invested in US companies. We do have some Chinese exposure as long as they have a US ADR. So we do have names there just under 5%. So turning over the slide, this is a snapshot of our top 10, 40% of the fund within these top 10 names, a real mix of names across the disease areas I just mentioned. Vera at the top there, we've been taking profits in that name after incredibly strong share price returns. We've got super large names like Amgen and Gilead, and then slightly smaller names as well. A number of these names we think are M&A candidates. So moving on to the NAV slide, we're an investment trust, so we can trade at a discount and a premium. At the moment, we're trading at a discount and we are buying back shares on a regular basis. I should note back in 2016, the board wanted to increase the pool of investors that could invest in IBT. So they announced the dividend at that point. This meant that income funds who wanted exposure to biotech but couldn't, could now invest. And it did everything we wanted it to do. Buyback stopped, the discount narrowed. We issued some shares back in 2019 and 2021 when we went to a premium, and currently we're buying back. So the themes for this year, we've increased our exposure to mid-cap companies. So I mentioned at the beginning that our volatility has increased. That's been an active top-down decision that Marek and I have made. We think there's real value there. We think that the biotech sector is coming back into favor. Patent expiries, I mentioned a big wave of IP expiries at the end of this decade. We think M&A will continue and the fund should hopefully benefit from more transactions. We use gearing tactically, as I mentioned. We have one eye on macro. And then something else at the beginning, I mentioned that paying out the dividend, the way we see it is our companies that we invest in don't usually have a natural income, so the dividend is paid out of capital. But we do have cash coming into the fund, quite considerable amounts sometimes, from M&A exiting companies that have been acquired. So last year we had 2 big acquisitions. Each of them at the time was our top holding in the fund. So Horizon, which was at the end of 22, and Seagen a few months later was our top position. They were acquired by Amgen and Pfizer, giving us a big chunks of cash coming in. We reinvested some of that cash into mid-cap companies, and obviously that could also be paid out to shareholders. So moving on to the next slide, just to graphically show you what I've been talking about. On the right-hand side, the past few months of the XBI Biotech Index, you can see it's been a story of 2 halves. So the sector fell going into the peak of interest rates in October and has since rebounded. And you can see that reflected in what we've done as managers. We had a big peak in our gearing position in October, and we've taken profits since then. On the left-hand side, you can see how the number of smaller companies has increased in the fund from 19 in June up to 33 at the end of January. A little bit on the venture part of the portfolio. So this is continuing to be managed by SV Health Investors. Currently, there are 2 funds within the venture part of the portfolio, SV Fund 6 at SV Health Investors and BCOF, which is a crossover fund. Right now, this makes up 8.5% of NAV. The board want the venture part of the portfolio to be within, say, 5 to 15%. So we're nicely sitting in between that at the moment. And finally, a slide on our dividends. So this shows the dividend payments since 2016, the 2 installments of 2%, 2%. We should mention it's 4% of NAV. So if the NAV rises, then the dividend payment will rise. And if the NAV falls, the dividend payment will fall. And over time, we've seen a nice upward trend since 2016. So that comes to the end of the presentation. Thomas, should we open up to Q&A? The Q&A?
Yeah, fantastic. Thanks very much for that. We've had quite a few questions already coming in, but if you're in the audience, there's plenty of time, so please do add yours. We had a question about how you divide the responsibilities up between the 2 of you.
Yeah, no, we get asked that often, and it's different how we do things to other funds, in that we don't segregate the sector and say, right, you do medtech, you do services, and you do cancer. That's not how we approach things. So we're both we have very different backgrounds. I've been following biotech stocks on the buy side, so I've got that sort of experience, the cyclicality of the market, etc., since the early noughties. Marek, however, has industry experience, so really understands about how to develop a drug. Every investment we take, we decide as a pair, we debate, we discuss each day, every day, how to manage the portfolio. The way we see it is we buy our portfolio every day. So it's a real joint effort, and it's what we bring to the table on each investment that makes it work, I think.
I can add to that. I think it's really good that we have the complementary backgrounds, and I think that provides us to take decisions that maybe that kind of we don't trample on each other, and the debates we have is more like how much should we own of a certain company or how much should we sell, rather than anything else. I think it works very well, and it's good to have someone to debate with as well. I think it's very because this industry is very humbling in the long run.
Great. So in past US election cycles, healthcare has been a hot topic. We had a couple of questions on this area. Do you think the US elections might affect the sector? And then maybe connected to that, is there any government legislation in the works in the USA, I guess from either parties, which might impact the sector and drug pricing?
Sure. So we've seen legislation. Legislation has now passed. Within the Inflation Reduction Act, acronym IRA, the Democrats have negotiated, basically say that Medicare can negotiate drug prices with pharmaceutical companies. This is the first time that's happened. And in Trump's administration, assuming he wins again, he didn't achieve any change in legislation. So I doubt, or we think, that it's not going to be top of the agenda. It's normally a political football, but I can't see Trump trying to bring this up when the Dems have actually achieved something. So it's likely that it won't be top of the debate list. It's probably more likely going to be geopolitical events, but we'll see what happens.
So we discussed quite a bit interest rates during the presentation. Do you have an idea, do you estimate, say, the duration of the portfolio? So if you would say, if there was a 1% fall in interest rates, would you expect a certain uptick in the valuation of the portfolio, for example?
That's a really good question. It's not like a bond you value, but we think, as Elsa pointed out in the beginning, we revalue our portfolio every day. And you also have to consider that the interest rates, it's not the interest rate as such, is more the trajectory of the interest rates that is relevant for biotech sector. That's number one. Secondly, you have the monetary policies as well and liquidity. I mean, it's a lot of other stuff that needs to function, and the real economy, labor market. It's a lot of other things we take into consideration when it's macro. Interest rates is just one of the things that stands out, but we have a lot of other tools in our toolbox to look for, and we do not decide primarily like if it goes up 1%, we will increase, but you will see an increase in the stock market, but primarily it will be the high risk names that move up the most.
And what we've seen, if you, I don't know if you can pull up the chart, but when the sector gets really hit is when interest rates are changing. So the rate of change of interest rates going up and the rate down rather than the absolute level of interest rates.
Yeah, moving around the slides is beyond my skill level. I'm afraid, so I won't try that. We'll go through the whole presentation in reverse. Maybe a connected question, possibly. Mid caps and small caps. So as you pointed out, they've been out of favour and had quite a nice rebound. What would drive a continual re-rating? Is it interest rates or is there something else?
I think at the moment we've had such depressed valuations, and hopefully now the market is normalized. So from a sector point of view, who knows, we might get, you know, the whole wave rising even further up, but really we feel it's more of a stock picking thing. So what will cause returns will be at a stock level, you know, which stocks are we invested in?
Yeah, but I can add to that. The last 3 years, we have seen a lot of consolidation in the industry in terms of a lot of companies have merged, bankrupted, or being acquired, meaning there are fewer companies there to share. I mean, the productivity is much better at the moment, so there is room for improvement. And at the worst stage, a couple of months ago, approximately 20 to 30% of companies were valued below the cash they had in the bank, which is a kind of a proxy for how depressed valuations were at the time.
Yeah. We had a couple of questions around the earlier stage pre-profitable companies. So what tends to drive the rating there? What percentage are currently unprofitable? And also in terms of valuation, how do you value pre-profitable companies? How do you think about that? Obviously, you can't use the normal multiples, I suppose.
Yeah, I can start with that. I mean, let's start with the big biotechs. The valuations are relatively simple there. You can use price earnings, etc. When it comes to the revenue growth, which still not have profits, but growth, then you can value it as price to sales or price to peak sales, which usually is a good proxy when you do acquisitions, which I've done previously in my career. This is kind of the proxies you use. When it's come to early stage, it's more art than science. In terms, science is the core, but you need to think about it. Is there scalability in the product? Some companies, they say there's a kind of a portfolio in one product, like Argenex is one of these companies that now has flourished and become a big company, and they have one product or one project that became 5 different diseases they treat. So you need to think about scalability, and also will they be the only ones on the market? That's another one. There is the monopoly scarcity value, so to speak, and innovation. Now, how innovative is this? As you can imagine, it's hard to value that, but once you have done it for hundreds of companies, you get a feeling for the valuation it should be. This is why also the valuations move a lot in terms of sentiment. To Elsa's point, if you get overheated market, you can have 10 billion valuation of preclinical asset, which bonkers now when you look back 3 years down the line. But at that time, it was a reality, right?
Was there a specific company you had in mind there?
Yeah, I can mention CRISPR Therapeutics, which had a fantastic, they
Yeah.
have a fantastic technology, gene editing,
Mm.
preclinical. They would, change the world. But then reality is there as well. You need to go through the clinical process, you need to get reimbursement, and you need to put the product on the market, and then you're valued according to different yardsticks. Suddenly you need to prove that you can sell the product. The valuations sometimes come down and you have the reality hitting you. But still great science and fantastic product.
One of the areas in the portfolio is rare diseases. Why are they an interesting sector to invest in?
Yeah, so I would say move the slides, but I'm not going to. So at the beginning of the presentation, Marek showed that the growth of prescription drug sales and rare diseases within that grows at the fastest rate. So I think it's 9% growth rate for rare diseases and 5% overall. So we like that area for the growth rate. Rare diseases inherently have smaller clinical trials, so 12% now, sorry. So faster growth and also cheaper trials to run. They're smaller and they take a shorter period of time to run as well. So it's a really exciting area. It's a good investment opportunity, rare diseases.
And on the unquoted, do you have a limit on the amount that can be invested, and how does that allocation vary? How's it moved around?
Sure. So the board decide on the allocation within the venture portfolio. As I mentioned, it's between 5 and 15% is where they want it to sit, and that's at investment.
But also, I think I've lost you. Sad.
Yeah, we lost the sound. Yeah. Okay.
The performance of.
Oh, there we are.
Can you hear me? Can you
You're
hear
back.
me?
Yeah. Sorry, we lost you for a moment.
Okay, so I'll start the answer again. The board decide how much exposure the trust has into venture companies. They have indicated they want it within the range of 5 to 15%. It's generally been within that range. Obviously, the performance of the quoted part of the portfolio will have an effect on that percentage. So if the quoted part of the portfolio does really well and say doubles in size, inherently that's going to reduce the percentage of the unquoted part of the portfolio. But naturally, it's actually sat around 10% over a number of years now.
Great, thanks. I've got a couple of questions left, but if you're in the audience, this is kind of a last call if there's something you want to ask. Could you just clarify? So do you have a research team alongside you, or is it just the pair of you?
So the way we approach this, and Marek should comment as well, is how Marek's business works in business development in biotech. So what we do is we have the managers at the bottom of a funnel, if you like, and we have input from key opinion leaders who are working in the industry today. So they're actually on the ground in biotech companies. And that way we are learning from them who are more experienced than us or know more than us about a disease or a drug or the company, for example. This model works in biz dev, and we've applied it to the fund management industry. We could have that a pyramid style approach where we're 2 fund managers and then a load of analysts beneath us, but we feel that the analysts would just regurgitate what we already know. So we've got this inverted pyramid way of managing the trust, which has paid off in the performance.
I can add to that. The reason why we wanted to work this is, to begin with, that we learn from the experts. And usually what the key is when you work in the industry, you do evaluation of a company, you need to have specific experts for this specific business area or key opinion leaders for this disease or expert. There is always 1 or 2 issues with one company that you need to sort. And if you have a team of experts, it will be impossible to kind of, they are so specialized, you cannot find jobs for them internally besides doing this. So we found it much more rewarding to actually ask the specific experts, and you get those answers and quicker. The nimbleness of this industry is very important because time is of essence as well.
Thank you. And so maybe a final question. We touched a bit on the heavy focus of the industry in the US. And we had a couple of questions around whether that's likely to change over time, particularly within Asia. I guess China's growing wealth, and is there scope, do you think, for the biotech industry to become more global?
Shall I start? I can start. To begin with, the reason why US is much more, I have them more investments, it's more mature. Biotech emanated in the US, and this is where you have the first generation biotech drugs or companies succeeded. Then you have the venture industry developed there, and then you have the Boston and San Francisco areas, which kind of continuously grind and churn new companies out. And as soon as a European company, I mean, on a research base, Europe and US, I would say very similar in that sense. But once a company have accrued a certain size, you move over to US because it's easier to raise money, it's easier to find the competent staff you want to get hold on, and the pay is better. So it's kind of natural at the moment. When it comes to sales, 40% of global sales approximately is in US, then you have 20 in Europe, or give or take, and the rest is spread all over the world. But having said that, early stage innovation, it's actually Europe and rest of the world is quite more balanced. So if you look at our venture portfolio, which Kate runs, it's much more balanced between Europe and UK and versus rest of the world. I don't know if else have any additions to that.
No, that's covered everything. Thank you.
Great. So in that case, I'll draw this to a close. Thanks very much, Elsa and Marek, for your presentation and for answering all those questions. And thank you, the audience, for your interest. Please do check out the note, which was published just yesterday on the site. And we hope we'll see you at future events. Good afternoon, everyone. Bye-bye.